Toronto condos fell 64% from 2021 to 2024. That's the lowest sales volume since 1996. Listings are surging while buyers completely disappear. This is what an illiquid market looks like. And if you need to sell right now, you're in real trouble. Many owners are refusing to accept the discount the market actually demands. Months go by, no offers. Their holding costs keep climbing. For example, their mortgage renews at 5% instead of 2%. Hi, Kane again. I was a theater grad that started with nothing. 20 years later, I own properties throughout Ontario, but it didn't come easy. Be sure to watch my biography video to see how I struggled. Also read the description to check my references used in this video. If there are any discrepancies, be sure to let me know. The information presented here are for educational purposes only. Always do your due diligence before you invest. By the end of this video, you'll know exactly why the can't sell problem is the most dangerous trap for 2020 to 2022 buyers. Without further ado, let's begin. What happens when you lock in a mortgage at 2% expecting rents to cover it, then rates jump to 5% before you even close? That's exactly what happened to thousands of Toronto condo investors between 2020 and 2022. Let me walk you through a hypothetical example so you can see how fast the math breaks down. It's 2022. An investor buys a condo for $800,000. They put down 20%, which is $160,000. They get a pre-approval for a mortgage at 2%. The plan is simple. The mortgage payment on $640,000 at the rate is around $2,000 a month. Condo fees run $400 to $600. Property tax and insurance add another $300 or so. That's roughly $3,000 a month in total carrying costs. The investor expects to rent it for $3,000 a month. So in theory, they break even and cover their costs, which is in line with 48% of condo investors during this period, according to this article. Within a year or two, they figured the value will spike 5 to 7% annually. Then they exit or refinance at better terms. That's the thesis. But then mortgage interest rates move. By the time they are ready to close, the bank does not offer 2% anymore. The best rate available is now 5%. The same $640,000 mortgage payment jumps to $3,500 a month. Now add condo fees at $500, property tax at $250, and insurance at another $150. You're looking at around $4,500 just to keep the doors open. Some months it's closer to $4,600 or $4,700 once you factor in property management if they hire someone. So what's the rent doing? Still $3,000 in spring 2005. Actually, some units are renting for much less because there's so much oversupply right now. The tenant has all the leverage, the landlord has none. You've got $4,700 going out every month and $3,000 coming in. That's a $1,700 monthly shortfall. Times 12 months, that's over $20,000 a year the investor has to pull out from their own pocket just to hold onto the property that's already losing value. This wasn't the plan. Most buyers didn't model for this scenario at all. They thought rates would stay low because they've been low for over a decade. They thought rents could keep climbing because they have been. They thought they'd flip within 2 years and move on to the next deal. None of that happened. The data shows how widespread this is. An Urban Nation and CIBC study found that in 2020, investors bought new condos were earning about $63 a month in positive cash flow. By 2022, that flipped to a $223 monthly loss. But that's just the average. By the first half of 2024, 81% of leveraged investors were cash flow negative. The average loss jumped to $597 a month. And the worst performers, the ones who bought at absolute peak. They're losing $1,000 or more every single month. Some are hitting $1,500 or $2,000 depending on the property and their rate. Here's what matters. This isn't a temporary squeeze. This isn't the market being down for a few months and bouncing back. This is the foundational math of the investment breaking down completely. The entire thesis was built on assumptions that have evaporated. Low rates, rising markets, quick exits gone. So now you've got 81% of investors hemorrhaging cash with no end in sight. But here's the thing, the monthly bleed is only half the problem. The real trap kicks in the moment you try to escape. In 2022, an investor signed a contract to buy a condo for $800,000. They put down a deposit. It's now 2024, and they're finally ready to close. The bank orders an appraisal like they do with every mortgage. The appraiser goes through the unit, looks at the comps in the neighborhood, checks what the other units actually sold for, and does his research. Then the report comes back. The appraisal says $650,000. That's a shock because the investor signed a contract for $800,000. The banks don't lend based on what they agreed to pay. They lend based on what the property is actually worth, and the bank will only lend 80% of that appraised value. So 80% of $650,000 is $520,000. That's all the bank will give them. Now, here's where it gets painful. The investor still owes $800,000 to close. The bank will only lend $520,000, so the investor needs to come up with the difference in cash. That's $280,000 out of pocket, but they only plan to put down $160,000, so suddenly they need an extra $120,000 they probably don't have sitting around. What can they do? Some lucky investors, they borrow against other properties to find that money. Some tried to get a bridge loan financing at higher interest rates, which is 7 or 8%, which is expensive, but at least gets them to closing. Some just walk away and ate their deposit because it no longer made financial sense moving forward. Why did appraisals collapse so hard? It's because it comes down to how pre-construction pricing works. In 2022 and 2023, builders were selling units at $900,000 based on hype and scarcity. But once those units got built, people could actually compare them to other units and other buildings. The real market price was different. The assignment market, which is people flipping pre-construction contracts before closing, shows actually how bad the gap is. Units that were contracted at $900,000 are now trading at $630,000. That's a $270,000 gap per unit. Investors who bought at peak 2022 to 2023 pricing are looking at estimated losses of 30% to 40%. And that's just a loss so far. It might just get worse depending on where the market settles. Even if an investors wanted to sell and get out, they can't. Let's say a buyer comes along interested in the property, but the buyer needs a mortgage too. The appraisal gap means that the bank won't finance it at the contract price either. The buyer would need to come up with an extra $120,000 cash just to close. Most buyers don't have that. The seller won't accept a $200,000 discount because that would be a huge setback for them. The buyer can't get financing without one. So the property just sits. No one buys it, no one sells, it doesn't trade at all. Toronto condo sales dropped 28% year over year in mid-2024, the sharpest decline among all property types. Yes, some of these condos were built too small for families, and it's also because deals failed to close. The financing doesn't work. The appraisal doesn't match contract price, and now you've locked in 3 different ways. If you're a 2022 buyer stuck in a negative cash flow right now, you've got 3 moves. First option is to hold and wait for the prices to recover. Maybe the market rebounds in 2026 or 2027 when supply finally tightens up. That's the hope, but here's what holding actually costs you. You're bleeding $597 to $1,000 every single month while you wait. Over the 3 years, that's $21,500 to $36,000 coming straight out of your pocket, and that's just the mortgage and fees. That doesn't include bridge financing you might need to close in the first place. Let's say you're $120,000 underwater on the appraisal gap and you decide to hold anyway. You need to close, so you find a bridge financing at 7% interest. That's an extra $8,400 a year just sitting on top of everything else. Add your conservative monthly negative cash flow of $597, and now you're looking at $15,564 annually just to stay in the game. Experts aren't even saying the market will recover until 2026 at the earliest. Even then, it's slow, so you might be holding for much longer than 3 years. Second option is to sell now and cut your losses. List the property, accept the market price, move on. Sounds clean on paper, but the numbers don't work. Let's say you owe $640,000 on a mortgage and a unit is worth $650,000. Sounds like you'll break even, right? No, after the realtor takes 4 to 5% in commissions plus HST and legal costs, you're paying just under $40,000 to sell. You're walking away with little or nothing. Sometimes you actually owe money at closing. That's only if you can find a buyer. Remember, listings surged while buyers completely disappeared. Months go by with no offers. Your property sits. The holding costs keep climbing while you're waiting for someone who might never come. The third option is the flip or assignment strategy. This was played in 2021 and 2022. You would buy pre-construction, wait for prices to rise, then sell the contract to someone else for a profit before even closing. But the assignment market collapsed. Units that have been flipped for $50,000 to $100,000 in profit in 2021 are now trading at $100,000 to $300,000 below what you originally agreed to pay. The data tells you how bad this really is. In 2022, 48% of new condo investors were still cash flow positive. By 2024, that flipped upside down. Now 81% are negative cash flow. The ones who bought at absolute peak are leveraged hard are the worst off. They're losing money every single month with no clear way out. Here's what a lot of owners do. They refuse to accept the discount the market actually demands. They list at $800,000, hoping for $750,000 when the market is really at $650,000. So listings sit for months. No offers come in. The holding costs climb higher. Eventually, desperation forces a fire sale at a way bigger loss than they would have taken if they would have just accepted reality 6 months earlier. The GTA condo market is illiquid because buyers are scarce, sellers are stuck. This isn't temporary. This is a structural problem that takes time to unwind. For 2020 to 2022 buyers who bought at the peak within equity, there is no good exit right now. Holding costs you money monthly. Selling locks in losses. Flipping is impossible. The best you can do is manage the bleed and hope things normalize in 2026 or later. The real lesson isn't that Toronto condos are bad, other than the micro apartments. The 2020 and 2022 cycle was built on assumptions that broke the moment rates went up. Investors counted on low rates staying low, rents rising fast, and quick exits. None of that happened. Now, 81% of leveraged condo buyers are negative cash flow with no profitable exit. The market is stuck. Listings pile up. Sales collapse. Appraisals come in low. Deals don't close. This is what illiquidity looks like. If you're considering a condo deal today, conduct your due diligence carefully and do not over-leverage. You may need to put more money down into the deal. Looking for another investment opportunity, I'm actually putting together a mortgage fund because I see a lot of investments out there that are for accredited investors only, meaning you need a high net worth in order to qualify to invest. Some opportunities take 5 to 7 years to complete before an investor can see a return on their capital. Dividends may pay out quarterly or annually. They may also require a minimum investment such as $50,000 or $100,000. I want to change all that. Our fund will have 10% annualized return paid to you monthly, and you don't need to be accredited. Minimum investment is $5,000. If this is something you think might fit your needs, check the description and sign up on our VIP list to be the first to know when we launch this opportunity. If you've enjoyed this content, be sure to watch my next video on how the rich protect their family assets and wealth.